talking about timing, maybe Pam, starting with you, can you educate us about the actual process of manager selection from your sort of personal experience, various vantage points, when you hire them to do the job? How do you go about that process?
Sure. When it comes to manager selection, so by that time, you already have a strategic asset allocation. So then there's an inherent kind of dilemma when you do the manager selection, because your strategic asset allocation usually is forward-looking and it's long-term. But when you do the manager selections, a lot of time it could be backward-looking and short-term focused. So we have to really make sure that you actually shift your process to align with the mindset of the long-term focus. So what we do is that the process is actually very straightforward. We use a database to start, for example, investment or personal network, and then screen down to a workable list. And then we focus on really 3 P: people, process, and philosophy. And I won't go into the details, but these are the 3 things that we really kind of focus. And also we start with quant. A lot of quantitative analysis from past performance, risk, return analysis, correlation, and all these attributes. But usually, when you start with quant, you can't stop there. Whether it's either from the manager selection process or the due diligence until even the firing, the termination process, quant always just a starting point. And then we move on to qualitative component of that. We look at philosophy, we look at process. Process is very, very important, especially during the very downsides. Are these managers able to follow their mandate, follow their process, whether there is an integrity of the process? So these are the things we're looking at. And then after that, we make a decision, and we're trying to figure out, if a manager has gone through the entire market cycle and has actually is able to explain the source of the added value through different kind of economic environments, then that's where we actually started making decisions.
There is a lot there to unpack, and we're lucky enough on the public side to have MEU sort of running a less established program. Maybe you're closer to the source of how you thought about your manager selection as well.
Yeah, I think that we may be somewhat unique in that we have not been investing in hedge funds for very long at all. In fact, I think it was in about 2015 when we got the mandate approved by our board of trustees. And so the way we went about it was we had, like other institutional investors, we are very long-term focused, and our strategic asset allocation is really the primary driver of returns. So that's determined by our board, and then staff is really executing those asset class portfolio construction. So back in 2015, we started looking at hedge funds, and we essentially looked at them as opportunity costs within each of the existing asset classes. So for example, as we thought about equity long-short portfolios as possibilities, we looked at them in concert with the rest of our global equities asset class, which is a very efficient, low cost. We manage over 70% of that internally, active and passive. So it's kind of a high bar. That portfolio is really there to deliver beta plus. So as we thought about equity long short, it didn't really make much sense to us standalone. However, when we looked within our opportunity fund, which is where we would put multi-asset class portfolios such as multi-strat, relative value, and potentially global macro, it made a lot more sense. The objective of that asset class is really risk mitigation. It's one of the objectives of it, improving the overall Sharpe ratio of the total plan. So that was where hedge funds started to make sense for us. So as we think about manager selection, it's really specific to diversification and then potentially adding value on top of that. But we look very closely at correlation to the equity markets given our overall concentration in equity risk at the overall total fund. So because we are relatively new hedge fund investors, we have employed a consultant to help us, which is quite unusual for PERA. Like I said, we manage a lot in-house. And so we did outsource some of that intellectual need to an external consultant to help us build out that portfolio. But the overall due diligence process is very similar to what Pam suggested. I think there are some definite best practices associated that she hit on earlier.
And Eric, I know as a chief strategy officer, you also give the tools to your team to select the managers, so maybe you could share some of the manager selection ideas that you have.
Sure. And just as a little bit of background, before I moved into my current role, I was the director of our hedge fund portfolio for several years. So, I'm going to echo what my co-panelists said in terms of the importance of looking at a lot of those quantitative metrics, and that is a key part of our process. And just to extend that a little bit further, one of the things that it's very important to us in manager selection is making sure that when we are looking at, say, a manager's stream of returns, that we feel that we have enough conviction in our process to adequately distinguish between what we think are maybe that kind of true managerial skill and those other things which are exposures which are perhaps available in cheaper, more liquid vehicles in the capital markets. And that becomes the kind of, hallmark of our process. Now, as a result, one of the things we've done from a process perspective is create this framework so that we can take in a lot of data on a lot of managers and be able to assess them, at least as a first pass, quite efficiently. The problem becomes, in terms of sourcing, the bottleneck is just in terms of the introduction to the managers. What we have generally found is that there are not that many managers that actually, once you unpack the different exposures, actually have a lot of true managerial skill or alpha that you're looking for. So in terms of kind of trying to size up a program, that becomes the true bottleneck. In terms of manager selection itself, it's not about who you know, it's not about access to the investment team. None of that stuff matters, right? At the end of the day, it doesn't matter how good a salesperson someone is. What it's really going to come down to is the fund of an institutional quality that we think we can invest in them? And then furthermore, does it have a set of exposures that's differentiated enough, that has enough consistency and repeatability that we feel we want to invest in it? And how does that fit into the overall portfolio?
So Eric, maybe staying with you for a bit, we would like to learn a little bit more about the performance evaluation of the ongoing funds. I know you watch everything. Trust me, you watch whether you wash your hands after you go to the bathroom. So what about performance measurement? You recently adhered to GIPS. How do you monitor the ongoing exposures that you've got?
Yeah, so recently PRIM adopted GIPS, and so we've become GIPS compliant at the fund level. So that's been, it was a new experience for us. As part of that process, we require that our managers, particularly on the public market side, or I should say liquid market side, be GIPS compliant. And I guess the importance of that is being able to have a consistent set of standards by which you can measure performance. So that's very helpful in terms of being able to not just make apples-to-apples comparisons against managers, but also to give our beneficiaries the kind of confidence that these managers that we have are performing or complying with a set of standards that's quite high. Now, in terms of what we're doing on manager evaluation, say within my team, aside from say the overall GIPS compliance, one of the things that we have done over the last few years is evolve our hedge fund program so that it becomes much more customized and has a far greater deal of transparency than in the past. Having managed accounts, separately managed accounts, is a key component of that. So of the $6 billion number I gave before, over 75% of that is now in separately managed accounts for which we have full daily transparency. So on that front, there's really nowhere for a manager to hide, so to speak, in that we're very much aware on a high frequency basis of what a manager is doing. Are they being consistent to their strategy? And if there is a performance issue, that's going to show up pretty quickly. The goal here is not to look over a manager's shoulder, right? In fact, we have a very, very long time horizon. So I don't want people to get the impression that the idea of having the transparency is to be calling up the manager twice a day and saying, why did you make this trade? But on the flip side, it gives a lot of confidence to our board of trustees that we can manage the risk of an alternatives program like hedge funds, and it gives us as staff more conviction that we can really know what's going on under the hood within a particular manager.
Amy, Pamela, what's your take on ongoing evaluation of alternative managers?
So for us, unlike our colleagues at Massachusetts PRIM, we have not adopted GIPS, the Global Investment Performance Standards put forth by the CFA Institute, at the total fund level. That said, I would say all of our public asset managers are GIPS compliant, and I think that would include our hedge fund managers largely. We have exposure to only 5 hedge fund managers at this time, and they are very large institutional quality managers, so they also likely participate in GIPS compliance, which I do think is a really important leveling of performance calculation, and Paul and I were talking about it backstage, that I think GIPS in general is evolving, and I think that's really going to put forward a real improvement in comparability across private asset classes. I think it'll be really important for the evolution. As more and more institutional investors put increasing amounts of capital to work in these alternative asset classes, I think standardization will be very important.
So I don't have anything to add in terms of the performance evaluation, but in terms of evaluation, which I view as part of the due diligence, and that's something that we take it very seriously, that we look at again, the process. I'm very big on process. And a lot of times when you do the investment in hedge fund or alternatives, so even if, for example, that the fund or the manager fails to outperform, especially in the bull market, but over the time, if it can actually provide a better capital protection and have a differentiated returns during the different kind of cycles of economic time zone, then over time, those the portfolio will benefit from these managers. And we try to focus again, and I think my panelists also both said long term, that if over the short term, 1 to 3, even 3 to 5 years, that something is not working, as long as there's no fundamental change in terms of investment philosophy or the mandate change, then the conviction you have to maintain. People hate losses more than they love gains. So a lot of times you make really short-term decisions, and you want to avoid that. You also want to see managers avoiding making those short-term decisions as well.
That's really useful. Now, a couple of you mentioned trustees. Of course, they tend to be almost by design, especially in public funds, lay people coming on board, and hedge funds tend to be more so emotive than other asset classes. How do you educate your trustees? How do you talk to them about your alternatives exposure? Maybe, Amy, starting with you, because it sounds like it was a pretty recent accomplishment that you were able to win them over.
Yeah, sure. It's an ongoing dialogue, Paul, and I think it's increasingly challenging. I think the lack of transparency associated with alternatives, hedge funds, private equity is a hot-button issue for many trustees. These are people who are representing teachers, et cetera. In the state of Colorado, teachers are, they're striking last year at the same time we were looking for legislation to cut benefits because of our underfunded status. So these are difficult conversations to have. At PERA, our governance is pretty unique, and it's really wonderful in that the Board of Trustees is responsible for the overall strategic asset allocation. They choose the strategic asset allocation, which results in a long-term rate of return assumption, which is what they use to discount our liabilities. So it's a very integrated conversation, and those assumptions are very, very important. But from there, the trustees really oversee staff's execution. So for example, they would give us, say, a 53.5% target to global public equities, and the director of equities would build a portfolio to deliver the beta objective assigned to it in the asset liability study. So wherein some public funds or other institutional investors report individual manager level performance and have conversations with their board of trustees, we definitely report that performance and have those conversations, but broadly speaking, staff is hiring and firing managers. So I think that governance approach is really beneficial in that the experts are actually making the hiring and firing decisions versus the lay board. And I think working in conjunction with the board on the strategic asset allocation policy results in a very compelling governance model for us.
So going down the line, I know Pam, at your last shop, HMC, you just about had alums running some of your hedge fund manager selection and remuneration. That must have been fun.
Well, the difference, and maybe the best part about that is that we're the trustee. You know, we're the trustee of our own funds. So we make the decision, and as you know, Harvard has been in the alternative space for a long time. The portfolio that I used to oversee actually has hedge fund component since year 2000. If our conviction is very strong that we wanted alpha, we wanted diversification, we wanted capital protection, and we have the expertise to hire these managers, then that we're blessed with the fact that we can just go ahead and do that. So we don't really have unlike the public pension fund, then it's the environment is a little different. So.
Eric, from your side.
So our governance structure is similar to what was described about Colorado, in that the way that we interact with our board of trustees is that as we set the strategic asset allocation, which governs how much we want to, in a range of, with a set of bands, how much we want to allocate to different asset classes, including alternatives. At that point, the program or the system that we have set up with the board is to describe in kind of broad terms initially what are the kind of exposures that we're looking for, what are the kind of overarching goals of having a hedge fund program, how would you measure success? To give a very concrete example of this, keep in mind that in Massachusetts, and it's probably the case in Colorado as well, the board of trustees of a state pension fund, it is not necessarily made up of investment professionals. On the 9-member board of trustees of Massachusetts, 4 of the trustees are members of the teachers or state employees union, and 1 is a state trooper. So the people are very involved. They're very, they care very much about this because their pension is affected. But at the same time, they're not necessarily an investment professional. And why is that important? Well, for example, we will see stories periodically, or have seen stories over time, that will say, for the 9th year in a row, hedge funds underperformed the S&P 500, or something like that. And it makes me happy that we've done our good job educating when a trustee will say, I had a constituent or I had a fellow teacher come up to me and say, why are we invested in hedge funds? And I could tell them, well, that's just about returns. Like that article didn't take anything into account about risk and the fact that our hedge fund program has volatility less than that of fixed income. So if you looked at it on a Sharpe ratio basis, our hedge funds have outperformed public equities. The fact that we, I think, have gotten our trustees to the point where they understand that and they actually see the benefits of having that kind of returns but with low volatility, how that adds to your portfolio or how that adds to the overall PRIM portfolio, that's been very, very helpful, because what it does is it also allows people to have much more of a long-term performance horizon.
Public school teachers educating other public school teachers about Sharpe ratio, that's a true achievement. So staying with the poverty anecdote, Eric, maybe you could share some of the names withheld stories about the hedge fund terminations and the reasons, the thinking that went behind that?
Sure. So, contrary to what maybe a lot of people think, mediocre performance is actually not a real likely reason that a manager gets terminated, especially if it's in the context of a strategy that perhaps is just not doing well in general. We've known that, for instance, certain quant strategies and certain macro strategies have struggled over the last couple of years. Just because a manager has not performed particularly well, that itself isn't a reason for termination. The best way to get yourself terminated as a manager is to not be forthright and not be respectful of your investor. So, we had one manager that did not disclose that they had kind of a partners fund, which they were funneling all of the best trades into. Most of you probably know who that manager is. Like a lot of other institutional investors, we terminated almost immediately. We had other managers that were, not responsive to client requests. If there was certain kind of reporting that we needed, and they don't provide that, we can't have that. Had another manager who was basically retiring, but didn't really want to tell us that. And so he tried to make it seem as if he was still managing the portfolio when he wasn't. Again, you can't keep these secrets for very long. That was another great way to get terminated, right? So in a nutshell, it's not that, you can't have mediocre performance forever, but the biggest reasons that we're going to terminate a manager are ones where the business relationship and the trust have been violated, and there's really no basis to continue working together after that.
That's absolutely right. And also termination, nobody takes those decisions lightly. It's very costly, it's painful. And also it's, human nature, it's very difficult to admit that, that there's a judgment error somewhere along the way. And also when you terminate a manager, it's not just the cost of the manager replacement. A lot of times you have to, hire a consultant to get the replacement manager. And also, for example, I manage the trust portfolio, that there's tax consequences as well. When you trust for the pension plan, it's not an issue, but for private wealth and for certain individuals, the tax consequences is very difficult as well. So trust is very trust, meaning not the charitable trust, I mean the trust in the managers, is a key component of that. There was one time we terminated the manager 3 months after we hired the manager because there were certain reporting standards that we were misled. And we weren't able to get what we needed, and this is a reason that Eric just mentioned. So in that process, it's very painful. And people who made the decisions take it very seriously and thinking that we, kind of, in a way, did not really see, or the due diligence at some part of it, we made a mistake. But once you make the decision, you cut your loss and you move forward.
So for us, we haven't terminated any hedge funds yet. So I guess for better or worse, we don't have a lot of experience with the termination side of things. Although I have a lot of experience with terminating and hiring managers in general, and I would think that the overall thought process is similar. In addition to what my colleagues here have very effectively discussed, I think that it goes sort of back to the asset allocation and the role within the portfolio. I guess I can't really emphasize that enough, wherein if a hedge fund or any other manager is hired for a particular mandate, those expectations have been laid out there, and your role within the portfolio should remain consistent. And so if the performance generated by the manager isn't consistent with the expected mandate, to me that is reason at least to understand what the heck is going on. I think just as in a stock portfolio, if you have a consumer staples company that you expect to shield your portfolio in a market downturn and it all of a sudden has new idiosyncratic risk associated with it, this is not dissimilar from that, wherein if you're hiring a global macro manager that is expected to be more defensive in your hedge fund portfolio and all of a sudden is very highly correlated with the equity markets, that may be cause for at least another look to see what's going on with that manager.
You mentioned a couple of segments, global macro and the like, so I think it dovetails nicely in the 5 minutes that we have left in terms of some sort of outlook. You clearly have some money to put to work. What would you, to the extent that you can, be able to share with the audience about that?
Sure. So for us, again, I'm the CIO, so I don't pick the managers. I approve them, but I don't actually choose them. But I talk to our director, and he has consistently been looking at multi-strategy relative value managers in particular, because essentially they have the opportunity to dynamically allocate amongst high-performing portfolios, et cetera, over time, and as such aren't really as concentrated in any one particular risk or one particular theme on a macro basis. I think within multi-strat, he's looking more and the Asian markets, as I think our belief broadly there is that there's some inefficiency associated with that market, those markets broadly, and while there may be some different risks associated with them, there are, we think, opportunities there that can be exploited potentially by multi-strat managers.
Oh, very useful. Down the line.
Similar to Amy, I no longer make specific investment decisions anymore, and there's a team that does actually the investment piece of that. So my main concern for charitable assets for endowment is principal, preservation, and as well as the liquidity. You can meet the liquidity need for these charitable assets. So that's what we're looking at, in terms of a total return standpoint, that we can generate enough liquidity as well as, protect the capital, and that's what we're focusing on.
Perfect. And as with all this.
So emerging markets is one area that we are spending a lot of time researching managers, trying to get some differentiated exposure. But when I say emerging markets, it's not even just that these managers are focused on emerging markets. In some cases, it's simply a geographic addition to the portfolio, because you might have a global macro manager in Singapore just think about the world differently than one that sits in New York or London. So, but on the other hand, we are also looking to just increase emerging markets exposure, because we do think that that can be potentially a profitable area for a hedge fund to trade in. Our portfolio by design is somewhat eclectic, so we do not make tactical calls with hedge fund strategies. We don't think that's really going to work, especially in the short term. And because we have a long time horizon anyway, that's never going to be a main focus of ours. That being said, the strategies that are always going to be at least marginally more attractive or marginally more interesting for us to investigate are the ones that have naturally low correlation to, say the equity market, or to a lesser extent the fixed income market. So things like global macro, volatility-based strategies, fixed income relative value, those are probably going to pique our attention a little bit more, but it doesn't govern what we do. And if you look at the managers that we've added over the last year or two, it's been all over the map. We have even added long-short equity because we thought that these particular managers made a lot of sense given the portfolio that we have. So it's, I think what we always kind of pride ourselves on is being kind of open to any idea. Most of those ideas aren't going to be particularly good, but we're at least open to that, to listening.
Well, one more thing, that many of our clients are looking at or demanding ESG investment. They wanted to make sure there's a sustainability, so those are the managers we pay a lot of attention to as well. Governance, sustainability, and social justice.
Yeah, fantastic. So we have 1.5 minutes left. Questions without notice. Any parting thoughts on the issue of manager selection? Maybe starting with you, I mean, going down the line.
I mean, I think we've hit on a lot of manager selection topics today. I think they're all relevant and important. Certainly, I've been really talking about the role within the portfolio. That's obviously my job. I'm sort of talking my own book. You build a portfolio, expect your individual manager selection to behave in a certain way, and I think that's the consistency associated with that is of the utmost importance. Again, I also talked about transparency. I think within the alternative asset space, there is a lack of transparency, and I think as investors increasingly allocate to these asset classes, there's going to be increased demand for improved transparency associated with hedge funds in particular. So I guess that's another parting thought.
2 words: discipline and conviction.
Okay, it gives 30 seconds to you, Eric.
Great. I think one of the key messages for us is that we want managers to understand that when we're looking to hire them, it is a long process, right? It doesn't happen quickly. There's a lot of diligence that needs to be done. There's a lot that we need to understand about how the manager works. And the more that a manager can appreciate that and really be an active participant in that process, the better the relationship we can build.
Thank you very much. With that, please thank Amy, Pam, and Eric for me.